And it's great to have you back. Just on Tesla, it sounds like you remain net skeptical, just given either production pressures or the idea that others are going to catch up on a relative basis.
I have stayed out of Tesla, and I'm going to continue to do so, even despite the strong June production numbers that Dee was talking about. The problem I have with Tesla right now is, instead of looking at it in a vacuum and just its own production capabilities and what it's growing like, what's the broader landscape doing? There was a great report that came out from Bank of America talking about the car wars and looking at Ford and General Motors looking to catch up and take overall share from Tesla over the next 5 to 10 years. And I look at that stock. I look, for example, at Ford trading at 0.3 times price to earnings to growth ratio. I look at Tesla north of 1.67. I look at the relative valuation. My money goes to Ford and it goes to the GMs.
Yeah, people like to talk about second mover advantage, and they always invoke Apple as an example. But I don't know, how much can we equate GM and Ford's prowess with Apple's manufacturing prowess?
Well, I think one of the things that Ford and GM has going for it is they've already got strong balance sheets. They've already got free cash flow being generated by the legacy business. And I think what they started doing slowly but really caught up doing much more quickly is redeploying their capital fast. They're not Apple historically, but they seem to have learned their lessons and they're moving. And I think the second mover advantage piece is hitting on a ton of other growth stocks as well.
The whole growth stock picture to me looks a little weird. I mean, in the past month, Snowflake is higher by more than 14%. DoorDash up better than 5%. There's some other things that are down. But overall, to start this week, I'm looking at China lockdowns and consumer spending. Some of the areas around Shanghai seem to be potentially locking down again, which would be a concern on the supply side. And then all these stories about consumer spending and sort of U.S. consumers spending down the savings that built up during COVID makes me wonder what happens in the second half of the year, since so much depends on whether consumers continue to spend. Are you watching those things as you make your, position yourself for the second half?
Absolutely. There are a couple of things I'm looking at the moment. So one is looking at what consumer default rates are on some of the loans, whether it's auto loans, whether it's credit card loans, to exactly this point that we've seen a degradation in the strength of the consumer balance sheet in recent months as inflation has continued to tear through consumer savings. And the second piece, too, is I'm sitting in Europe at the moment. Europe is in likely recession. To your point on China, there has been some pop-up in growth, but the growth outlook broadly globally has slowed down, and I don't think that's been fully priced in yet. What that means for revenue, not only for the growth stocks, but for the broader US market, where significant revenue is generated overseas. And now we've got a double whammy of slowing consumer demand internationally and a strong dollar, which just doesn't help the domestic currency revenue generation and just for the sort of export market generally. So I'm pretty nervous coming into the second half.
And what do you make of the tech trade today? Do you trust it? I'm looking at the top 3 gainers on the NASDAQ 100. It's Datadog, Zoom, DocuSign. You were just laying out some of the concerns. They aren't as susceptible to the stronger dollar. I see the 10-year at 2.8 right now. Do you think that this can last?
I'm not optimistic about this lasting, Dee. And just to hone in specifically on Zoom and DocuSign, those two are names I think are particularly vulnerable to this issue of second mover advantage. Those were product innovators during the work from home phenomenon. Now, remote signing of legal documents, now using video conferencing. These are widgets that belong in the product suites of much stronger companies like the Microsofts of the world. So I think businesses like the Zooms, like the DocuSigns, frankly, like the Affirms of the world, that are single product businesses have got a little bit further to fall. And I particularly do not trust the pop we're seeing in those kinds of names right now.